good afternoon. I'm in Ireland at the moment, where it is afternoon, but I'm sure for everyone else, whether in South Africa or Mauritius, it's hopefully Friday afternoon for you. So thank you for joining today's webinar debrief. Our special guest speaker today is Deborah Tickle, who you unfortunately cannot see or hear currently, but hopefully you'll be able to. So Deborah Tickle is a highly distinguished tax expert, and she was a partner at KPMG Cape Town for many years. She is a member of the Davis Tax Committee, which gives her some wonderful insights. And she is also a professor of tax at UCT. But far more importantly than all of those, to us at least, Deborah has been a long-term technical tax advisor with Regan van Rooy, and she gives all our technical support on our complex tax matters. So we're now Friday, 2 days after the much delayed budget speech, and there's been a lot of press, a lot of discussions about the changes. But from what I've seen, everyone is just talking about two things, being the increase in the VAT rate. Obviously, it wasn't as high as we initially feared, but the tax rate has gone up by 0.5%, with another 0.5% to come later. And of course, the non-increase of all of the various personal tax bandings, which gives a very real pocket impact to everyone affected. So that's what the discussions have largely been in the press over the last 2 days, and we're hoping to do something different today. Hello, Deborah. I'm glad you're there.
I was panicking with the grayed out mute and camera, so.
Well, you know, Deborah, not as much as I was panicking, thinking if I'm going to have to do this debrief on my own. So I'm glad you're with us.
Apologies to everybody.
Guys, so apologies for that start. We have Deborah with us, and Deborah, I was just saying, I've introduced you, and I was just saying that in the last 2 days since the budget speech that we finally had after the exciting and unexpected delay, everyone's really been talking about the VAT rate increase and the non-increase in the personal tax bandings. So we're hoping to do something different today, and we will be talking a lot about the other changes that we think are very important and haven't been covered so much in the media. But before we dig into that, and this is always a question I ask before any budget presentation, is can you give us the kind of big picture background to the budget speech that happened? Like, where are we now and what has brought us here?
Okay, so I know you said we're not going to talk about the VAT, but perhaps some background as to looking back to 2016, which is a long time ago. The Davis Tax Committee was asked to look at the economy holistically and to suggest to government where they could find additional taxes to fill the holes that they had in funding. And at the time, the Davis Tax Committee said that there were various options. So one could increase the personal income tax by 6%, or increase the VAT by 3%, or increase corporate income tax by 5%, and those numbers, or the amounts that those would provide, would be roughly equal. So what we saw in 2018 was an increase in the personal income tax by an extra 4% of the 5%. I think we'd really had the 1% previously, because we used to have a 40% tax rate as a marginal rate. Then it went to 41. Yeah. Now we have 45. So that was up to 45. We also saw a 1% increase from 14 to 15% in the VAT. And so we've already used up some of that option. When they came to this year, I think, having dipped into various pots, if you want to call it that, like if you think from last year, we had the gold and foreign currency contingency reserve, which gave 100 billion, of which 50 was used last year, 25, they haven't mentioned that again, but 25 this year, 25 next year. They had the two-pot system. There's always some pot that they can dig into. Suddenly, they don't want to increase debt, because we're already paying over 20 cents in every rand of tax to the interest bill. They wanted to get the money somewhere else. And having looked back at the Davis Tax Committee report, I'm sure they said, well, we've got another 2% here. So back in February 19th, the Treasury is saying to themselves, we've got no real other option because where else do we get the tax from? Suggested or didn't suggest. It was all withdrawn last minute with a lot of political mongering. The 2% was withdrawn. And then the question was, what do they do? So they've had lots and lots of discussions. And one could see in the speech on Wednesday, the irritation in some respects of Minister Godongwana, because he said, you know, what am I doing now? So what I'm doing is I'm going to suggest 0.5% VAT increase this year, 0.5% VAT next year. And that increase is due, if it happens, to come into play on the 1st of May, which is problematic in itself because it's a month later than they've planned, as it were, because everything would have been the 1st of April. And it's not enough. So they've had to look for other pots. So what have they said? For the 3rd year running, we're not having a bracket creep change. And they've dug into the pot of increases to social grants. So where the excuse of why we don't want the 2% increase was, well, it's going to hurt the poor. What they've done is said, okay, well, we won't have that 2% increase. We will take it from another pot, being the bracket creep, which actually a lot of lower earning people have to pay tax that weren't paying tax or will have to pay more tax, and social grants, which is obviously a bit of a dig, I guess. But it's interesting when one looks at that whole VAT proposal versus the number of taxpayers in this country, and I say this at nearly every seminar that's got to do with the budgets. We have a very, very small tax base. If one looks at earnings or taxable income, I should say, of more than 500,000 Rand a year, and this comes from the 2024 tax statistics, which are released by Treasury and SARS, one sees that there are 1.3 million people who actually earn above that figure. That figure is equivalent to about $27,000 a year. So this is not, we're not talking about massive earners here, although obviously there are a few, but not many. And those people pay 78% of the tax, of personal income tax. They represent 2% of our 60 million population. So you've got a very small bunch of people who pay that tax. And those are the people who actually pay most of the VAT because they're the people who've got any money to pay it. So the point about it not being regressive is actually to an extent true, particularly because of the proposed zero ratings. Will this all go through? Big question mark, because against this background, we have to say to ourselves, well, what is going on in this country? And we all moan about service delivery, blah, blah, blah. The point is that the Auditor General issued a report last year and said that over the last 5 years, 406 billion rands, 406 billion rands worth of wasteful and irregular expenditure was found. That's 81 billion a year. So bear in mind that they're looking for 58 billion in the extra 2% or from these other sources. I can see the politics going all sorts of places. So whether it will get passed or not is another matter.
The question. Wow, that's a very interesting context. And some of the figures you've given us there are quite staggering. So I think let's go on to what we think of as some of the more interesting amendments in Annexure C. But before we do that, and you mentioned about, this will be debated in Parliament and whether it'll pass. Can you just give us an overview of the process? So what happens with the budget? What is Annexure C that all us tax nerds talk about? And what happens after that? And what can we be looking for in future?
Of course. So it's quite an annual process that we all go through. And as you say, we tax nerds, we kind of are totally engrossed in it most of the time. So in around about October, November, Treasury and SARS call for what they call Annexure C changes. And it's a very, how can you say it? It's a very good process in the way that we are able to give input. It's not always taken, but at least we're given the opportunity to give input. So tax like SICA and SITE and Regan van Rooy and anybody who happen to want to can put a submission into SARS and say, we think this particular section is not doing what it's supposed to do. and it should be doing this, or, you know, introduce a different tax completely, or whatever people feel like. That is then looked at, and whatever they think is a reasonable change, and often it's technical changes, but there are often things that are hidden into this Annexure C, which appears in the review. So when they have the budget, which was meant to be on the 19th of February, there was a sort of pre-release, which wasn't supposed to be, but then they approved it, of that review, which has now been re-released, slightly changed on Wednesday. There's a section on income tax and revenue, how they're going to sort of collect their revenue, where it's going to come from. But then there's this Annexure C, which lists a whole pile of suggested changes, which we will then see pulling through to the draft legislation, which we'll see in June, July. What we then have is, and we're always moan because we're given like 2 weeks or a week to give comment, but at least we're given the opportunity to give comment. And we are able to also have meetings with Treasury. They invite people to come and have present their points. And the legislation is then either revised or remains the same, depending on whether Treasury and SARS believe that it's a reasonable point that's been made. And then we get a second draft, and that draft is generally what is put in place as the final legislation, which is then passed, be it in December, like we had 24th of December, the Christmas present, or sometimes, sometimes it gets delayed to January, and then you're already into the next year's system. So that's the way it all works, which it's a good system. It's a good system if your budget goes through. So it'll be interesting to see if we don't, because obviously the later these things come in, the more sort of there's revenue lost to the Treasury, because there's a month later and a month later and a month later that things are actually implemented. So it's an interesting, this year is very, very interesting.
And I know we did say we're not going to only talk about the VAT and personal thresholds, but in terms of the VAT, the administration and implementation of these changes is going to be a big deal. And given that there is real uncertainty this year as to whether the changes will go through and from what date, because of the process you just explained. So I think we're going to see real challenges there for businesses, because not only is any that change a big deal to implement, we're going to now have two, you know, the first one, and then the second one, and potentially another one. So do you see there's additional complexity and uncertainty now for taxpayers in trying to figure out how to handle these changes, particularly in terms of the VAT rate?
Well, I do. And I think because we're having the half and the half, I think it's making it sort of a double whammy, as it were, because when you do have a change, obviously 30th of April, the VAT rate is 15%. 1st of May, it's 15.5%. And changes need to be made throughout the business world where you have a VAT registered vendor. Now, that all sounds very well and good. I mean, if you're just issuing a few invoices every month, fine, you can issue them at 15.5 versus 15. But if you are, for example, a retail store, you might have to change all the pricing on your products so that people know what they're actually going to pay. They're going to pay an extra 50.5%. But the thing that's very important is to understand the time of supply rules. And Caoilfhionn, I know you have specialists in VAT with with Regan van Rooy, who might help if any of the clients find difficulties with this. But just to give an example, which I heard about yesterday, and I was completely unaware, is that if you have a commercial property which is being transferred, and the deposit has been paid but is held in trust account, so that it hasn't actually, there's no consideration actually being given. So let's say this agreement signed in February, a deposit's been given, but the transfer and the payment for this commercial property only happens 3rd of May. There could be a requirement for an extra 0.5% on the purchase price. That's assuming, obviously, it doesn't really matter, I suppose, if you can claim it back, but if you can't, this could be a significant increase in the price of the property. But also to get your documentation right. Everybody's put an agreement in place with 15, and
And then you have to
it should
change
be
everything.
15.5. And obviously
Yeah.
SARS isn't interested in the fact that somebody's claiming it back. You have to have it right in your VAT return.
Yeah.
So a lot of complexity there that needs to be dealt
Yeah.
with twice, not just
Yes,
once.
yeah, at least twice. And speaking of complexity, let's now jump into Annexure C.
Yes.
Can you talk us through what you see as the main changes that have been mooted in terms of what it seems like extra tightening of many tax provisions to try and squeeze a bit more tax out of the already existing tax laws?
Yeah, it's interesting because initially I thought it was all squeezing out, but actually it's not all squeezing out. And some of it is, I think, because they realize they're squeezing too hard. And that's the first one. And I've tried to only select things that deal with international tax because there's a very long list. I mean, we could be here all afternoon if we were to work through the whole list. So I've got 4 or 5 specific items that I think will be relevant to your clients. And the first one relates to trusts, which I think is a very pertinent aspect. And what happened, and everybody will probably remember this because there was a lot of publicity about it. In 2023, with effect from 1 January 2024, there was a change made to the trust legislation that said if a local, in other words, a South African trust, distributes to a non-resident, the tax must be paid in the South African trust or in the donor's hands, not in the non-resident's hands. Now, in those submissions that were made to SARS and Treasury, a lot was said about the fact that if that occurs and a recipient is a non-resident and is taxed in their country, then effectively, whatever they receive, they're going to be taxed twice. So it's none of these Annexure Cs are 100% clear on what they're intending, but from what I'm reading, what they seem to be wanting to do is look at this because they're saying that there is additional tax on those non-residents. So they've realized double tax treaty relief is not available because it's not the non-resident who's paid the tax, it's the trust. There's 2 separate entities, and they can't, it's not equitable for that to be the case, that there's this kind of, I mean, you could end up with more tax than in total than the actual distribution. So I think they've realized that.
Well, that's good news then. So that's good news then. So it's a tidy up to ensure unintended economic double taxation.
Yeah, well, that's what we hope that means.
Yes, let's hope. One to keep an eye on, but hopefully it's a tidy up provision then that will be helpful to the taxpayer.
Yeah. Then the next one relates to the controlled foreign companies, and this is also quite interesting because, as everybody here probably knows, a controlled foreign company is a company that's more than 50% held by South African tax residents. And if that is the case, unless there is an exemption, of which one is the high tax exemption, the other relates to activities. But looking at the high tax exemption, what they say is if the country that the CFC is in, if significant amount of tax is paid there, then don't worry about it being paid or attributed here. And what they've discovered, and I think the wording is debatable in the legislation, but what they're saying is that where you have a situation where the tax is paid by the company, the controlled foreign company, and then there's a dividend declared to the shareholder, some countries give a credit for underlying tax to the shareholder in the country. So let's say, and Malta is one of those countries, for example. So if you just look at the tax that's paid in Malta, you would satisfy the high tax exemption if it's a CFC. But when the dividend's paid out, then the shareholder can get a portion of that tax back, which means it wouldn't satisfy if you take the two together. And as I say, I think the wording covers it, but obviously what they're discovering is that I would suggest this has been being used, and probably quite legitimately they've queried, and there's been a good argument put forward as to why the wording doesn't cover it. So now they need to relook because they thought that it was being covered. So that probably is going to be taken away. It was quite a clever loophole, I guess, if it depending on how you read it. So that was that one. The next one I selected was relating to foreign exchange gains and losses between connected parties. So let's say you have what they call an exchange item alone between a South African entity or person and a non-resident that's connected. The legislation currently states that under certain circumstances, the gain or loss can be delayed until realization, which is actually quite nice, because with our, I always say it's like a jack in a box. It's up and down, or fluctuating exchange rates. It can be quite penal or quite beneficial depending on where it is at the end of the year. But it is, it can disrupt cash flow, I think, for these companies. And it's purely a fiction in many respects because it hasn't been realized. But what they're saying is that they want to review that. So whether they're finding that there's some games being played, I don't know. But it's likely to be a change that's not going to be favorable.
Not good.
To taxpayers.
Okay, so that's one. Yeah, that is one to look at carefully, because as you say, with a volatile currency, those are very real cash impacts.
Yeah, and it can be a loan either way as well.
Yes,
so,
exactly.
Yeah. So that's that one. And then the next one is a very interesting one. I must say, when I was looking at it, I was thinking, I can't understand why they've said this, but when one looks at it again, maybe. So the definition, the section in the legislation, I know it all sounds very technical, but the definitions in the legislation include definitions of foreign company, foreign partnership, foreign dividend, and foreign return of capital. So there's specific definitions to cover the fact that not all regimes have the same types of shares and companies that we have. So they're specifically defined. But the definition of equity share specifically just says a company. So it refers to a company. It doesn't refer to a foreign company. And so somebody very clever, presumably, has used that and said, oh, that doesn't apply to a foreign company because it only refers to the word company, and foreign company is defined. So we can use it some other way, or maybe they need it to be, you need it to be included in the definition of equity share, because the term equity share appears many, many times in the legislation. Yeah. So what they're saying is they want to relook at that and amend it so that it does cover these foreign companies. But I wonder if that might, and until we see how they draft the legislation, who knows, but it might have an impact on foundations, which, depending on how they are constructed, can sometimes be a company from a South African tax perspective, or sometimes be viewed as a trust from a South African.
Yeah.
So we will wait and see.
Yeah, and this is one we'll watch with great interest. Our view at Regan van Rooy of foundations has always been, to be they're untested and not to use them in lieu of a trust. Many people were kind of hailing them as the perfect combination between a company and a trust. But I do think you're right that this may well bring foundations, basically mean that they're treated more as a company and therefore could be a controlled foreign company rather than if owned by a trust rather than being if owned, instead of a trust being ignored. So this will be a very interesting change to monitor.
Yeah, it will be interesting because of also the definition of participation rights has never, not that equity share is 100% relevant for participation rights, but it might provide some clarity. Who knows? It's going to be, as you said, we tax nerds will get all excited about it and see what comes in June, July. And then I've just got a final one, which is really an admin point, and that relates to, and many companies import. We are not a self-sufficient country, despite the fact that we may need to become more self-sufficient based on what's happening in global politics at the moment. But when there's a dispute specifically relating to VAT or customs and excise on importation of goods, if anybody's gone through a dispute, they will know that it's very cumbersome, because you've got the VAT sort of side of it, you've got the customs and excise side of it, and sometimes you'll also have the income tax side of it because of the transfer pricing which can occur, which nobody ever thinks about. But what they've said is that they want to have a look at the dispute aspect, and they want to review it to make it more aligned, I guess, so that you're not dealing with 3 different departments, I would suspect. So again, we will wait to see, but it is very cumbersome. And one of the problems we have is that the Tax Administration Act is not, it doesn't cover the Customs and Excise Act. So you've got these 2 different pieces of legislation which deal with, how you interact with SARS depending on which tax, which time, money, effort, it's just not, for them and for the taxpayer, it's just not really viable. So as it says, it's sort of 5 or 6 interesting points. There are probably 25, 30 points in the Annexure C. but many of the others not necessarily relevant to your clients. Or I can recommend anybody who's interested going to the Annex GC of the review. It's on the Treasury website if they're interested.
Yeah, and I think these 4 that you've mentioned will really be important to keep an eye on. So we'll see in June or July when the legislation comes out, and before then, I guess we'll see how the various discussions in Parliament go.
Yes. Oh, well, let's just hope that we have a finalised budget, because working without certainty is
exactly
definitely not helpful.
It's worse for everyone. Guys, thank you all very much. We're mindful to be on time. So we do have 2.5 minutes if anyone has any questions on what Deborah has explained so far. And otherwise, apologies again for the technical glitch. It was added to by the fact that my laptop, I just traveled to Ireland yesterday, and my laptop seems to have given up the ghost en route. So I've actually had to join in from my calls from my phone. So it was a bit of a technical hiccup. Guys, any questions on what we have covered? Doesn't look like we have any. Well, we will share the recording with everyone who's registered. And if you have any questions or there are any topics you'd like to ask us about, you can reach out to us. My email is cvandervolt@reganvanrooy.com. And otherwise, we will keep in touch and let you know how the various legislation looks whenever we see it.
Thank you.
Thank you very much, Deborah. Very nice
Pleasure.
summary.
Thank you.
Bye-bye. Bye.